They sold you a dream. Buy a house, build equity, watch your wealth grow. That is what they told you. That is what everyone believed. Work hard, save up, get on the property ladder, and your future is secure. Now thousands of people wake up every morning in homes worth half what they paid, with insurance that tripled overnight, with bills that keep piling up, and no way out because nobody is buying. This is not some distant crisis happening to other people. This is happening right now in cities across America. And the scary part is how many folks still think it cannot happen to them. Here are 10 cities where the dream turned into a trap.
Number 10. Boise, Idaho. Boise was supposed to be the escape, the hidden gem, the place where regular people could actually afford a house with a yard, mountains in every direction, clean air, space to breathe, and prices that made sense. People from California and Seattle flooded in, thinking they found the answer to everything wrong with the coasts. Between 2020 and 2022, home prices shot up 70%. Houses that sold for $300,000 were suddenly going for $500,000. Buyers paid over asking just to beat the competition. They waived inspections. They wrote love letters to sellers. They did whatever it took to get in before prices went even higher. Everyone said the same thing. Boise is different. Boise will keep growing. Get in now or get priced out forever. Now those same homes are selling in the high 200s. Some owners have lost $250,000 in equity, $250,000, money they worked decades to save, gone in 24 months without them doing anything wrong. But here's the part nobody talks about. Those remote workers who drove up prices, a lot of them left. Companies started calling people back to offices. Remote work policies tightened. The Bay Area paychecks that made Boise prices possible packed up and went home. What stayed behind? Prices that local teachers and nurses and firefighters never could afford. And homeowners who bought at the peak now trapped in properties worth way less than their mortgages. New subdivisions sit half empty on the edges of town, rows of houses built for a boom that already ended. Some have gone through distressed sales. Others are selling at massive losses just to get out. Investors who thought they would flip for profit are now praying to break even. Wildfire risk keeps pushing insurance costs higher. Certain zones are getting expensive to insure, another bill on top of everything else. Longtime residents watch their quiet city transform almost overnight. Prices pushed out their kids and grandkids who grew up here. And now that the wave pulled back, what is left? Empty new construction and neighbors who cannot sell without bringing a check to closing.
Number 9. Las Vegas, Nevada. Vegas always loved to gamble, but this time the bet was not at the blackjack table or the slot machines. It was in the neighborhoods, spreading across the desert floor. During the boom, median home prices climbed to $475,000. Investors bought everything in sight. Short-term rental properties multiplied on every block. Everyone figured tourist money would flow forever. This is Vegas. People always come to Vegas. That confidence did not age well. Now that median sits in the high 200s, a 60% drop in some segments, and plenty of analysts are saying it still has not hit bottom. More pain coming. All those Airbnb investors doing the math in 2021, they are bleeding cash now. Occupancy rates dropped. Competition exploded because everyone had the same idea. Tourists started shopping for deals and staying fewer nights. The projections that worked on a spreadsheet 3 years ago do not work anymore. Some owners are waking up to realize their rental income does not cover the mortgage, does not cover the taxes, does not cover maintenance. They are paying out of pocket every single month to hold on to properties that keep losing value. Meanwhile, the cost of living in Vegas keeps climbing. Water scarcity is getting national headlines. Lake Mead keeps dropping. Record heat makes summers feel dangerous. Utility bills in July and August can wreck a household budget that is already stretched thin. Insurance costs are rising as environmental risk gets harder to pretend away. Carriers are paying attention to climate data even if buyers were not. Workers in hospitality and entertainment, the people who actually keep Vegas running, cannot afford to live here, even after the correction. Their wages did not keep up with the boom. They are commuting from further and further out just to serve drinks and clean rooms. In the newer subdivisions on the outskirts, you see the evidence. Half-finished projects, quiet streets where builders expected families. Plans that made perfect sense 3 years ago look like mistakes now. Some families who bought late in the cycle owe more than their house would sell for today. They are stuck, cannot sell without writing a big check at closing, cannot refinance because the value dropped too far. They just keep paying the mortgage on an asset that is underwater.
Number 8. Austin, Texas. Austin was the golden child everyone wanted to be. Tech companies moving in, live music on every corner, young energy, breakfast tacos. The city that had it all. Everyone said this place could only go up, so they kept buying at any price. Home prices surged over 90% during the pandemic. People relocated from California and New York thinking they found the promised land. They paid $700,000, $800,000, $900,000 for houses in neighborhoods that sold for $350,000 just 5 years earlier. They told themselves it was still a deal compared to San Francisco. Now the median has dropped from $575,000 to under $385,000. A third of the value evaporated, and there is more weakness in the pipeline. The tech layoffs hit Austin hard. Big names slashed headcounts. Hiring freezes spread through the industry. Those shiny high-rise apartments downtown that symbolize the boom? Sky-high vacancy rates now. Desperate concessions, free months of rent, waived deposits, whatever it takes to get someone to sign a lease. Owners who bought brand-new condos at peak prices are discovering there is no resale market at the numbers they paid. Buyers dried up. The ones still looking are demanding steep discounts. Nobody wants to pay 2022 prices in 2025. Mortgage rates above 7% killed the enthusiasm for expensive urban living. Hard to convince someone to fork over close to $1 million for a small lot, a tiny yard, and finishes that already feel dated. Listings that would have sparked bidding wars over a weekend now sit on the market for 4 to 6 months collecting dust. A new construction home in East Austin that hit the market at $799,000 is now listed at $499,000. Still sitting there, still waiting. The summer heat is getting more brutal every year. Power grid concerns keep making headlines every time temperatures spike. Insurance costs keep climbing. Utility rates jumped. Water restrictions are part of the conversation now. That migration wave that brought thousands of new residents, it slowed down. Some of the people who moved here during the hype are quietly packing up again, heading somewhere cheaper, somewhere that did not overpromise and underdeliver.
Number 7. Cape Coral, Florida. They called it the waterfront dream. Little Venice, 400 miles of canals winding through the city, every house with access to the water, boat out your back door, sunsets so perfect they looked photoshopped. In 2022, the median home was $465,000. Buyers were throwing elbows trying to get in, offering $50,000 over asking price just to win the deal, waiving everything, desperate to lock in their piece of paradise. 2 years later, that median is around $260,000, a 40% collapse, and nobody is saying it stopped falling. But the price drop is not even the worst part, not by a long shot. Insurance. This is where Florida absolutely breaks people. Annual premiums of $8,000 to $10,000 on houses worth $300,000. That works out to $800 a month just for insurance, just for the right to be covered. Before the mortgage payment, before property taxes, before HOA dues, before you fix anything or improve anything. And that is if you can even get coverage. Major insurers packed up and left Florida. They ran the numbers and decided this state is not worth the risk. The companies still writing policies here are picky. Old roof? Denied. Too close to water? Denied. Any previous claims on the property? Denied. Good luck finding someone else. One couple bought their place for $380,000 in 2021, put down everything they had saved. First-year insurance cost $4,000. Okay, manageable. Second year jumped to $7,000. Painful but survivable. Third year, the company sent a letter saying they were done, not renewing. Find another carrier. They called everyone. The only company willing to insure them wanted $11,000 a year. Meanwhile, their house is now valued at $240,000. They owe more than it would sell for. Their insurance payment is almost as big as their mortgage payment, and they are stuck. Then Hurricane Ian came through. Roofs ripped off, streets turned into rivers, people's lives torn apart in a few hours. Families figured, okay, this is why we pay for insurance. This is when government disaster relief kicks in. Reality was uglier. Contractors smelled opportunity and tripled their rates overnight. Some took deposits and disappeared. Government assistance meant mountains of paperwork, endless waiting, denials for technical reasons, appeals that dragged on for months, all while the damage sat there getting worse. And then came the letters from homeowners associations. Special assessment notice, $15,000 for seawall repairs, due in 90 days. Where exactly does a family that is already drowning find $15,000 in 3 months? Now everyone wants out. Houses sit on the market for 6 months, a year. Nobody is buying. That listing that started at $899,000 eventually sold for low 400s. The seller felt lucky to get anything at all.
Number 6. Salt Lake City, Utah. Salt Lake was supposed to be the affordable alternative to the crazy West Coast. Stunning mountain backdrop, Mormon hospitality, growing tech presence, ski resorts in your backyard, and prices way below California or Seattle. People priced out of coastal cities saw it as the perfect landing spot. Home values exploded 75% between 2020 and 2022. Remote workers and transplants bid aggressively on everything, paid over asking for modest houses in regular neighborhoods. The fear of missing out was intense. Now prices have cratered over 40% from those peaks. The median dropped from around $620,000 to the mid-300s. Recent buyers are deep underwater and quietly freaking out. Builders did not get the memo that the party ended. They kept pushing new projects in suburbs and foothill communities, confident that demand would stay strong. Now those listings sit for weeks and months without offers. Sellers are tacking on desperate phrases like motivated and bring all offers, accepting price cuts they would have rejected instantly a year ago. The rental market went soft too. Property managers dangling free months of rent, gift cards, reduced deposits, anything to fill units. Landlords who bought expecting steady appreciation and rent increases are watching their returns vanish. Some smaller investors are quietly hunting for exits, willing to sell at a loss just to stop the monthly bleeding and move on. Environmental risks are stacking up. Wildfire danger in the foothills is growing every summer. The hills are drier. Burns are more common. Earthquake risk that nobody used to mention is now part of every insurance conversation. Homeowner associations got stricter. More rules about everything. More fees, more friction between neighbors over parking and landscaping and rental restrictions. The people who moved here thinking they discovered hidden value, some of them are stuck now. Homes that cannot unload for what they owe, watching their investment shrink month after month while costs keep climbing.
Number 5. Phoenix, Arizona. Phoenix was the poster child for Sunbelt migration. Affordable sunshine, wide open spaces, lots big enough for a pool. Prices that made California transplants feel like they won the lottery. At the peak, the median home price hit the low 600s. Demand flooded in from higher-cost states. Investors bought aggressively. Remote workers showed up expecting permanent flexibility. Builders launched subdivision after subdivision across the valley floor. Then interest rates jumped.
Demand evaporated almost overnight. Prices dropped close to 50% from the peak. Typical homes now sitting in the low 300s. For anyone who bought during those frenzied peak years, this is not an abstract problem. This is the difference between having equity and being completely stuck. Listings now sit for 5 months or longer without serious interest. Sellers are accepting offers way below their asking price, throwing in closing cost credits, offering to buy down mortgage rates, including brand new appliances, whatever it takes to get someone to sign. But here's what makes Phoenix especially rough: the heat. Triple-digit temperatures for months on end. May through October is basically survival mode. Utility bills that can break a family budget when the AC runs non-stop. Power companies keep raising rates and pointing at grid strain as the excuse. Long-term water supply from the Colorado River is now under serious scrutiny. The river is overtapped. Allocations are getting cut. Some new developments are facing tighter restrictions. Permits getting harder to pull. Insurance companies are rethinking their appetite for risk in hot, dry regions. Policies cost more. Deductibles are higher. Exclusions for heat-related damage are expanding. Another cost that keeps growing. Investors who projected easy rental cash flow are revising their math and finding big holes. The numbers that worked in 2021 do not work now. Phoenix was sold as affordable sunshine living. What nobody advertised was that affordable depends on stable utility costs, reasonable insurance, water that keeps flowing, and jobs that stick around, not just the sticker price on the house. Families who are planning to relocate here are having second thoughts. The correction changed how a lot of people see this valley.
Number 4, Myrtle Beach, South Carolina. Classic beach town postcard, wide sandy stretches, high-rise resorts, golf carts everywhere, tourists flowing in from up and down the East Coast. During the pandemic, Myrtle Beach became an investment-feeding frenzy. Buyers from all over grabbed beachfront condos and short-term rentals. The logic was simple. Tourist dollars will always cover the bills. People will always want the beach. Since 2023, home values have dropped over 45% in many areas. That surge flipped into a brutal slide. The problem is painfully familiar. Too many investors all chasing the exact same playbook. Too many similar units flooding the market at once. And a mountain of costs that nobody saw coming. HOA fees running hundreds of dollars every month, even in buildings with obvious maintenance problems and aging infrastructure. Owners watching their equity disappear while still writing fat checks for dues, special assessments, and repair bills. Cash flow that looked great on a spreadsheet is now break-even at best. Plenty of owners are losing money every single month and just hoping something changes. Insurance got ugly fast. Hurricane and flood concerns pushed premiums through the roof. Some carriers reduced coverage or flat-out canceled policies after minor claims. One bad storm or one rate hike can flip a property from asset to anchor overnight. New construction keeps coming, even while existing units sit empty. Developers who started projects during the boom are finishing them into a down market. That feeds oversupply. Prices drop while operating costs stay stubbornly high. The service workers who actually run the tourist economy live further and further inland, commuting into a beach town where half the balconies stayed dark during off-season. The beach investment dream promised passive income and steady appreciation. What showed up instead was falling values and rising costs with no end in sight.
Number 3, San Francisco, California. San Francisco was supposed to be untouchable. Tech money pouring in forever, global prestige. The idea that real estate here could actually decline in a serious way seemed laughable. Then it happened. Peak median price was near $1.6 million. Now it is under $900,000 in many neighborhoods, a correction of over 50% in some segments.
exposed the myth that this city only goes up. Remote work rewrote everything. Downtown offices emptied out. Major companies downsized or relocated entirely. Commercial vacancies climbed to levels nobody expected. The neighborhoods that depended on office crowds watched restaurants and shops close one after another. Buyers who stretched to pay a premium for proximity to tech headquarters are questioning now whether those addresses mean anything. Teams are scattered, hybrid is normal. Why pay extra to be near an office that half the company never visits? Residents who maxed out to buy small condos at peak prices feel the weight now. Property taxes based on inflated values, HOA dues that did not drop, insurance costs that stayed high while the asset underneath lost half its value. Some buildings have monthly HOA fees in the 4 figures while critical repairs wait. Seismic retrofits postponed, plumbing that needs replacement, elevators that break down. Owners trapped between selling at a huge loss or paying to hold something that keeps costing more. Wildfire risk in the hills reshaped the insurance map. Some providers pulled out of entire zip codes. Households left scrambling to find coverage at any price. Safety concerns, boarded up storefronts, homelessness in every neighborhood. These are part of the calculation now when buyers think about San Francisco. Not just price per square foot, the whole picture. The city that symbolized limitless tech wealth is learning what happens when speculation runs into real-world limits. Crumbling infrastructure, unaffordable costs for the workers who keep things running. Questions about who can actually stay and what kind of city is left.
Number 2. Naples, Florida. Naples was concentrated Florida luxury, perfectly manicured everything, gated communities with guards at the entrance, golf courses designed by famous names, waterfront estates with private docks. Retirees and second home buyers came from everywhere. This was the place to enjoy the money you spent a lifetime earning. At the peak, average home prices touched $1.1 million. Premier neighborhoods went way higher. Now, plenty of those same homes are selling for half. Some high-end condos dropped even more. The assumption that luxury coastal property only appreciates got tested hard. Severe storms showed how fragile the whole setup was. Hurricane Ian and the storms that followed caused massive damage across the region. Rebuilding costs went through the roof. Flood risk and wind exposure got very real, very fast. Insurance premiums in Collier County have tripled for some owners since 2023. Policies that ran $4,000 a year now cost $12,000 to $15,000. That is not a typo. Annual insurance bills with 5 figures. Citizens Property Insurance, the state-backed insurer of last resort, is completely overwhelmed. Demand exploding, applications piling up, approvals taking months, conditions getting stricter, homeowners waiting without coverage, hoping nothing happens in the meantime. Property taxes still calculated on old valuations, paying taxes on a price the market will not pay anymore. HOA fees in nice communities run $800 to $1,500 a month as a baseline. Then come the special assessments, storm damage to common areas, seawall reinforcement projects, clubhouse repairs. One owner got hit with $35,000 due in 90 days. People who planned to pass these properties to their kids are now focused on getting out. Behind the beautiful gates, there's a quiet exodus happening. Owners listing before the next storm hits, before things get worse. The golf courses are still green, the yachts are still floating at the docks, but underneath the pretty surface, owners are paying more every month for properties worth less every quarter.
Number 1. Palm Springs, California. Palm Springs turned into a lifestyle symbol. Mid-century modern architecture, desert minimalism, the Instagram aesthetic come to life, celebrity history, and perfect weather. During the pandemic surge, median prices pushed toward $1.2 million. Buyers from LA and beyond grabbed vintage homes and bungalows and turned them into stylish, short-term rentals, designed for the camera.
Premium nightly rates, strong bookings, social media did the marketing for free. Then the desert got hotter, heat waves more intense and more frequent. Travel patterns shifted away from places where stepping outside in summer feels dangerous. And local officials decided they had enough of the rental chaos. Permit caps, stricter enforcement, steeper fines for violations. The rules changed. The math fell apart fast. Owners who built their entire plan around high occupancy discovered their permits could not be renewed under the new rules. The income they counted on vanished. The expenses stayed exactly where they were. By 2025, median prices dropped to the high 500s, more than 50% down from the peak. In the zones that were heavy with short-term rentals, the drop was even steeper. Insurance added more pain. Wildfire risk in the region keeps climbing. Several major carriers reduced their California exposure or left entirely. Homeowners stuck with higher premiums, fewer choices, bigger deductibles, and more exclusions buried in the fine print. Energy costs in a desert where air conditioning is survival, not luxury, keep climbing. Water restrictions and fines for overuse add another line item to the monthly budget. The city still photographs like a dream. The economics of actually owning there changed completely. Homes that looked like guaranteed stores of wealth are suddenly hard to sell at any price. Properties bought as rental cash cows cannot generate enough income to cover the carrying costs after utilities, maintenance, management fees, and taxes. Streets that buzzed with visitors during peak season now have more for sale signs than occupied driveways. Fashion collided with speculation, collided with environmental reality. Reality won.
The pattern exposed. From Boise to Vegas to Austin, from Cape Coral to Phoenix to San Francisco, from Myrtle Beach to Salt Lake to Naples to Palm Springs. Same story in different zip codes. Prices pumped up by hype, cheap money, and speculation. Costs hidden until it was too late to back out. Insurance that tripled without warning. Assessments that showed up out of nowhere. Values that collapsed while monthly bills kept climbing. The people who sold these dreams collected their commissions and moved on. The banks approved the loans and moved on. The builders finished the houses and moved on. The people who bought are still there, stuck. Cannot sell because they owe more than the house is worth. Cannot stay comfortably because the costs are eating them alive. Cannot refinance because values dropped too far. Cannot walk away without wrecking their credit for years. Trapped in homes they cannot afford to keep and cannot afford to leave. And somewhere right now, at this exact moment, someone is sitting at a closing table, signing papers on a house in one of these cities, excited about the future, believing they found the dream, not knowing what is coming.